Hello, I'm Lowe, and I want to give you a bit of an update as of January 2024 early, what we're doing in our portfolios. Now, first of all, we don't want to dwell on what we could and should have done in 23, because clearly I think for us in relative performance terms, 23 was a disappointing year, and for that we can only apologise. Undoubtedly, there were some effects such as base effects and unusual skew of returns within the market. But actually, the key driver behind the winners of last year very much emphasise exactly why we look for what we do in terms of what's really core in our philosophy. And that is we only want to invest in companies that are either going to attain high returns on invested capital and sustain them over time and grow at the same time, or even better, improve. And what generally happens, the leaders of last year, they actually showcase that. So to give you an example, let's take NVIDIA. And what we're showing here is what we cash flow return on investment. And we're ideally looking for companies with very high returns on invested capital, or CFROI, and them to be maintained over time. As we started last year, the market was expecting, in the case of NVIDIA, returns to be much lower than they were historically, i.e. falling. The reality was what we saw was obviously the first innings of that major wave of AI adoption arriving much quicker and to a much greater degree than expected. So by the end of the year, which is showing in blue here rather than purple, instead of falling returns on capital, NVIDIA was able to exhibit actually significant increases in returns on capital. Another example would be Meta. Again, you look in the purple, what the market was looking for in terms of consensus. Indeed, very much we believed that at the time as well, that competition, a cycle in terms of advertising down cycle and back of a weaker economy, and misallocation of capital, there's going to be significant deterioration of returns on capital for that business. But the reality turned out to be somewhat different. What we saw was significant cost cutting. We saw significant reallocation of wasting of capital in the metaverse, actually back towards AI. And by the end of the year, actually consensus was telling you, and we agree with this as well, that actually it is being able to sustain high returns on capital for much longer and to a much greater degree than expected. One other key lesson we want to share from last year was actually what everyone expected to be defensive, particularly in a world of slowing growth, higher rates, and the threat of recession. One would expect a more traditional defensives to do better. But the reality was that wasn't the case. Now, if we delve that into a little bit more detail, we can see here in the case of healthcare or consumer staples, a couple of typically widely regarded defensive sectors, they underperformed quite notably last year. Now, that in part may be because obviously there was not a deep recession. There was a slowdown in growth, effectively what some people describe as a soft landing. But also we think there's a longer term dynamic at play here. And that is that not traditionally, over the last decade, we've seen in the world of QE, many investors have been seeking yield in the equity market to substitute what they could not find in the fixed income markets. So when yields are zero, a low volatility dividend yield suddenly became a lot more attractive. But the harsh reality is now you can get 4% on the US Treasury at year end. Why do you need to bother taking that equity risk? And we genuinely think there's been a reallocation of capital away from some of these more defensive yielders in the market. And as a result, they're being derated in tandem with rising bond yields. And that very much is a mirror image of the previous significant re-rating in the QE era. That process is underway. Don't believe it's maybe not yet complete, and certainly a challenge for some traditional defensives. Now, the other factor for last year was, well, what is defensive? Now, if you look at the larger cap technology firms, a key change for last year, I've already mentioned, was obviously the emergence of AI. as a significant driver for businesses and effectively creating a new arms race in that area. And the key thing is that large tech companies are actually very well placed to benefit from that. They've got the data, they've got the engineers, they've got clear use cases of application, and of course, they've got the ability to spend. On top of that, these businesses are very high cash flow generative and strong balance sheets. So we would suggest, in general, they've become more the defensive, large liquid areas of the market of choice in a lower growth world of where investors want to park their money. But of course, we also have this, what they call the Mag 7 effect. And our suggestion would be that actually, whenever you come up with an acronym, that is not a substitute for an investment philosophy. It's more likely to be just a fashion. You know, whether it's going into different countries or in individual stocks, it's not a good reason to invest. And there are some companies we think have benefited that more general flow and positioning, where many large cap names have just been bought because they are large cap. And Apple's a relatively good example. It's a business where the return structure hasn't changed. It's had no upgrades. In fact, it's had downgrades. But despite all that, if we look at the rating relative to the market, and this is in the red line here for Apple, we're showing the relative rating to the world despite its low growth prospects that we see, given its relatively mature smartphone market and rising competition, particularly in China. It's actually become very expensive relative to the world, which we don't think the high P premium you're paying is justified by its growth. Contrast that with NVIDIA, which we do like, which has been significantly derated on the massive upgrade it's had, on a degree of controversy and skepticism over the degree to which the high returns on capital and growth can be sustained, which we believe it will. Drop. Obviously, inflation has dominated last year, and we've gone from the early part of the year and rising bond yields and worry about the scale of inflation to, by the end of the year, we saw effectively bonds in 10-year treasuries were back to exactly where they started at the beginning of the year, and a wave of disinflation coming through due to supply factors, pullback in commodity prices and so on, and now hence potentially calling out for a reduction in interest rates on the back of weaker inflation. We would suggest, though, as you look into 24, there's a couple of things to consider. Geopolitics, multiple elections in almost every major key geography with unknown outcomes, and we don't pretend we can easily predict those. Secondly, central banks are just beginning to regain their credibility, having effectively generated a wave of inflation through the ridiculous monetary experimentation, particularly post-COVID, and the willingness to go back to the printing of money again, that we think will be quite limited. So rates will probably, even if they do decline, will likely stay higher for longer. The other element to consider, obviously, the fiscal extravagance, and particularly we would highlight the US here. We've got very large deficits are ongoing, combined with a change in monetary policy gradually taking place in Japan after a long period of yield curve control. And to be honest, the impact of all that, we're not 100% sure. Besides, there could be major variables to keep an eye on. But what we think you should keep an eye on, and actually as investors being stock pickers, is really picking out those pockets within the markets where we genuinely believe they are on the paths that we're looking for. As a reminder, they are the paths of either sustaining growth and high returns in generally a low growth world, or even better, showing particular areas of improvement that many other investors don't fully recognize. Let me quickly run through some of those examples. Now, the first one is we do look for companies delivering that unique drivers of improvement. And a couple of names here in larger cap, technology related, fit that bill exactly. I already mentioned Meta, which is in the line here, which is in red, significantly re-rated, exactly because of the things I highlighted earlier in terms of they're changing the way they run their business to make them more efficient and much more high returns on capital, and that is very company specific in nature. The other one is Netflix, with a major change in their business model in terms of charging for non-paying subscribers for the first time. We believe that's improving their underlying cash flow, revenue, and profitability in an industry where clearly they are becoming the only profitable leader, where many of the other key competitors are increasingly retrenching, able to compete with Netflix positioning. Another area would be travel. Generally believe that the travel in the long term, that investors typically underestimate the degree to which the large emerging nations of the world are going to be a source of significant growth in traveler numbers. As their GDP per capita increases, combined with obviously ability to travel with visas, airline seats, and passports, particularly in case of China, and gradually more increasing spending power in India. Both those countries have got 1.4 billion people each. Only a small proportion of those emerging to become global tourists for the first time can have a major impact on some of the global travel. And we've got 3 companies in the portfolio which generally were already benefiting from that in 23, despite the challenges of the tech-related benchmarks. We expect that's going to continue in 24. Another key driver we think to always look for is market share gainers. Now, US general insurance is a rather relatively dull industry, but there are some companies that have got better business models, better IP and technology, and as a result are significantly growing much faster than the general insurance market, and therefore providing superior growth and superior returns on equity. But in a world with large cap dominated, some of these companies which are a bit more mid or smaller cap, in terms of Ryan or Palomar, we believe actually they're being not getting the spotlight they deserve. They didn't deliver last year, but the underlying driver of these businesses are as strong as ever. We reckon both Progressive, Ryan, and Palomar are going to be great investments for 2024. I mentioned AI adoption, and we openly admit in the earlier part of 24, we missed the degree to which that wave of adoption was accelerating really, really quickly. But we reviewed, we've reappraised, and these are the companies we've identified we believe are actually that first innings of adoption has just started, but this is a multi-year growth story. And Broadcom, NVIDIA, Synopsys, and to a lesser degree Microsoft and TSMC are all notable beneficiaries of the picks and shovels of that spending wave that are taking place. The arms race for the major tech players spending from a competitive point of view, and dare I say a genuine arms race in terms of government-related spending as well, ultimately which all these companies will benefit from. Another area is healthcare. We genuinely believe in the long term, those companies that are able to deliver solutions to make healthcare more efficient will be longer term winners. Indeed, many of the areas such as healthcare equipment and tools over many years have delivered high returns on capital and have had characteristics not dissimilar to some other technology-related companies, and generally have been more correlated with them. Unfortunately, in 2023, that wasn't the case. A couple of things, and the main driver being there was a degree of overhang on the back of COVID-related spending and then prior unwind and therefore return to unwinding back of excess inventory, and that has impacted the revenue growth and profitability over the shorter term. Our longer term view clearly didn't pay off last year, but we suggest the thesis is very much in place. Inventory clearance is a one-off factor, and eventually investors will come back to reviewing the high quality growth and return on capital these companies can deliver, and then during 24 we will get payback for that. And indeed there's some encouraging initial signs that we're beginning to maybe be seeing that for the first time. Another area is the enablers of energy transition. The shift towards alternative energies requires a significant amount of greater spending on efficiencies or indeed the new solution providers. There's a range of companies we've been held in the portfolio, some of which have done reasonably well last year, some have lagged somewhat, but Worley, Schlumberger, ChampionX and Schneider, we believe longer term will continue to be a good area of alpha. We have reduced a bit in that area, it has to be said, in 23, because obviously the higher cost of capital or interest rates is impacting some players and CapEx over the shorter term. But these key winners I've just mentioned here, we believe will continue to be leaders next year. So in summary, 23 was not a fantastic year, but if you consider the things that drove why 23 was challenging, that wave of adoption of AI emerging for the first time, or secondly, the other factor, healthcare, which we believe is a longer term, not had payback in 23, but we believe will be in 24. And then finally, stock picking overall. If you look back over the 12 years we've managed money as a team, unfortunately, our hit rate wasn't great last year. Indeed, it was a significant outlier compared to our very long-term track record. If we look at 24, we believe we're well placed in terms of whether it's AI, we're well placed in whether it's healthcare returning back to be leadership again, and actually our long-term success rate of picking stocks, we don't believe, hopefully, again, we'll have another outlier year in 24. So we're encouraged to where we are. Hopefully that update was useful. And as usual, we'll provide a more comprehensive quarterly update of the full review of last year and last quarter sometime during February. Thank you for listening.